Welcome back to the channel. If you are investing in the UK, you need to pay close attention right now because the rules for capital gains tax, or CGT, has fundamentally changed for the 2026 to 2027 tax year. The Chancellor has pushed the main CGT rates up to 18% for basic rate taxpayers and a staggering 24% for higher and additional rate taxpayers. And worst of all, the tax-free annual exempt amount is firmly frozen at a historically low £3,000. That means if you make even a modest profit on your stocks, crypto, or a second property, HMRC is going to want a much bigger slice of your pie. In this ultimate 10-minute masterclass, I am going to walk you through exactly how these new 2026 rules work, and more importantly, the legal and highly effective strategies you can use to protect your money and pay less tax. Let us dive in. First, let us look at the math and why this is such a big deal. In the past, we enjoyed a generous £12,300 allowance. You didn't really have to worry about tax on small trades. Now, at just £3,000, it's incredibly easy to accidentally trigger a massive tax bill. Let's say you invest £20,000 into a US tech ETF and it grows by 20% over a couple of years. Your gain is £4,000. You decide to sell. Under the old rules, you would pay absolutely zero tax. But under the 2026 rules, you subtract your £3,000 allowance, leaving you with £1,000 of taxable gain. If you are a higher rate taxpayer, HMRC takes 24% of that, which is £240 gone. Imagine if you are rebalancing a much larger portfolio. If you don't track this properly, the tax drag will destroy your wealth compound. That is exactly why we built CGT taxtool.uk, the ultimate capital gains tax calculator for UK investors, to automate this nightmare. Furthermore, calculating your gain isn't as simple as subtracting your buy price from your sell price if you have bought the asset multiple times. HMRC uses a system called Section 104 pooling, where all identical shares are pooled together to form an average cost base. This pooling average is what you must use to calculate your capital gain, and CGT taxtool.uk handles this math for you automatically. So, how do we fix this tax problem? Our main weapon against CGT has always been the stocks and shares ISA, but what if you already hold massive gains outside an ISA in a general investment account? This brings us to our first and most powerful strategy: the bed and ISA. The bed and ISA strategy is simple in theory. You sell your shares in your general investment account to deliberately realize a capital gain, and then immediately buy those exact same shares back inside your ISA. By doing this before the April 5th tax year deadline, you can use up your annual £3,000 CGT allowance to wipe out the gain and move the assets into a tax-free wrapper for the future. You are essentially harvesting your allowance, locking in a higher average cost base without paying a penny in tax. But here is the catch: you can only shield up to £20,000 worth of assets per tax year, because that is the strict ISA contribution limit. Also, you must carefully calculate your gains before you sell. You want to realize exactly £3,000 of profit. Sell too little and you waste your allowance, because remember, if you don't use it, you lose it. It does not carry over to the next tax year. Sell too much and you trigger a punishing 24% tax bill on the excess. Let's look at a concrete example. You own 500 shares of Apple in your GIA, currently sitting at a £5,000 unrealized gain. You don't want to sell all 500 shares, or you will pay tax on £2,000. Instead, you use a tool like CGT taxtool.uk to calculate exactly how many shares represent a £3,000 gain. Let's say that is 300 shares. You sell those 300 shares, you take the cash proceeds, transfer them into your stocks and shares ISA, and immediately repurchase the 300 shares of Apple. You have cleanly harvested your 3K allowance and shielded those shares forever. Many modern brokers even offer an automated bed and ISA button that handles the sell, transfer, and buy process in one go, minimizing your time out of the market. But what if your ISA is already completely full? What if you still have massive gains in your GIA that you want to crystallize, but you are terrified of the 24% tax rate? This is where our next strategy comes in, and it involves doing the opposite of taking profit: harvesting losses. The most misunderstood aspect of UK capital gains tax is that the £3,000 allowance applies to your net gain, not your gross gain. This means you can deliberately crystallise or harvest your losses to wipe out your taxable profits. Imagine this scenario. You bought Amazon stock, which has soared, giving you a £10,000 unrealised gain.
If you sell it all today, you will owe tax on the £7,000 excess above your allowance. At 24%, that is a brutal £1,680 tax bill. But what if you also own Tesla stock and it has plunged, leaving you with a £7,000 unrealized loss? If you sell your Amazon shares and your Tesla shares on the exact same day, your gross gain of £10,000 is immediately offset by your £7,000 loss. Your net gain is exactly £3,000. You pay zero tax. By technically pruning the losers in your portfolio before April 5th, you can dramatically shield the winners you want to lock in profits on. But tracking your combined net gains and losses across multiple trades and brokers is a massive headache. That is exactly why you need cgttaxtool.uk. You can simply upload your CSV trading statements from Interactive Brokers, Freetrade or Trading 212, and our software will instantly calculate your net gain across all your accounts. It's the ultimate what-if simulator for loss harvesting. However, maybe you don't have any losses to harvest. You just want to crystallize your £3,000 gain today and jump straight back into the exact same stock tomorrow. This is where investors fall into a very expensive HMRC trap.
The 30-day bed and breakfasting trap. You might think to yourself, I will just sell my shares in my GIA today to realize my £3,000 gain and then simply buy them straight back tomorrow in the same GIA. Unfortunately for you, HMRC is way ahead of this trick. Under the notoriously strict bed and breakfasting rules, if you sell a stock to realize a capital gain or loss and then repurchase the exact same stock within 30 days, HMRC completely ignores your sale. For tax purposes, they treat it as if the transaction never happened. You don't get to successfully realize the gain, meaning you entirely waste your £3,000 allowance. To correctly crystallize a gain in a GIA without triggering this anti-avoidance rule, you must wait at least 31 days before buying the exact same asset back into the same account. But being out of the market for a whole month is hugely risky. You could miss out on thousands of pounds of growth. The solution to this dilemma is a clever, perfectly legal technique called Proxy Asset Swapping. Instead of buying the exact same asset back, you immediately buy something incredibly similar that tracks the exact same underlying market, but is technically structured as a different fund by a different provider. Let's look at an example. Your 3K gain is sitting in the Vanguard S&P 500 ETF, ticker symbol VUSA. You sell it today. To avoid the 30-day trap, instead of buying VUSA back tomorrow, you immediately take that cash and buy the iShares S&P 500 ETF, ticker symbol CSPX. Because these two ETFs have different management companies, HMRC categorically considers them entirely different assets. However, because both funds map directly to the S&P 500 index, your portfolio's market exposure is essentially identical. You have successfully crystallized your gain, you have harvested your precious £3,000 allowance, and you remain fully invested in the market. But what if you own individual stocks like Microsoft or Nvidia? You can't just swap Microsoft for another Microsoft. In that case, we must look to our final strategy.
The spousal transfer. In the UK tax system, transfers of assets between spouses or civil partners are treated on a no-gain, no-loss basis. This means gifting shares to your husband or wife does absolutely not trigger a capital gains tax event, at least not yet. This creates an incredibly powerful tax planning opportunity. Let's imagine you have a large portfolio and you have already maximized your own £3,000 allowance. You still have further gains you want to realize, but doing so would mean paying 24% tax. If your partner hasn't used their 3K allowance yet, you can simply transfer those heavily appreciated shares directly to them. Once the shares land in their account, they can sell them on the open market. Your partner can then use their own untouched £3,000 allowance to crystallize the gain entirely tax-free. Boom! You have just doubled your household allowance to £6,000. Even better, if you need to sell assets that far exceed both of your allowances combined, you should strategically transfer the excess shares to the spouse who pays a lower marginal rate of income tax. If you are an additional rate taxpayer, you'd pay 24% on the excess CGT. But if your spouse is a basic rate taxpayer, any gains above their allowance will only be taxed at the lower 18% rate. That 6% difference can add up to thousands of pounds over the years. To wrap up this masterclass, the new 2026 capital gains tax rules are punishing for retail investors, but with careful planning, bed and ISA strategies, proxy swapping ETFs, and utilizing your spouse's allowances, you can legally and effectively minimize your tax drag. The key is to take action now. Do not leave it until April 4th to figure out your exact Section 104 pooling and unpooled cost bases. Go to cgttaxtool.uk right now, upload your latest broker statements, and automatically calculate exactly where you stand. Thanks for watching, hit the subscribe button, and I will see you in the next one.